On January 27th, Nvidia, the undisputed king of AI on Wall Street, suffered its worst single-day loss in nearly 5 years. A staggering $589 billion was wiped from its valuation in just one day, the largest market cap loss in history. For a stock that's seen a jaw-dropping 2,000% gain over the past 5 years, this crash has left investors wondering, is this the beginning of the end for Nvidia and the tech rally? In this video, we'll break down what caused this historic drop, why institutions are fleeing, and what it means for your portfolio. Plus, we'll reveal the one strategy you need to protect your wealth in today's overvalued market. Let's dive straight in. Let's start with the facts. On January 27th, Nvidia's stock plummeted, making its worst day in nearly 5 years. This wasn't just a minor correction, it was a full-blown crash, erasing $589 billion in market value. To put that into perspective, that's more than the entire market cap of companies like Netflix and Coca-Cola. So what caused this massive sell-off? There are two key factors. Number one, institutional sell-off. While retail investors rushed to buy the dip, institutions stayed away. Why? Because of China's new AI tool called DeepSeek. This low-cost alternative to US AI solutions has sparked fears that American tech giants like Nvidia may not be able to dominate the AI space as expected. DeepSeek's ability to deliver similar AI capabilities at a fraction of the cost has shaken confidence in Nvidia's long-term dominance. Number two, overvaluation concerns. Nvidia's stock has been on a historic run, but its price-to-earnings ratio of 36 is far above the historical average of 16. This has made institutions wary, especially as competition heats up in the AI sector. When a stock is this overvalued, even a small piece of bad news can trigger a massive sell-off. Nvidia isn't the only tech stock looking overvalued. The so-called Magnificent Seven, Tesla, Amazon, Microsoft, Apple, Meta, Google, and Nvidia are all trading at sky-high valuations. Here's the breakdown of the PE ratios. Tesla with a PE ratio of 137, Amazon with 39, Nvidia at 36, Microsoft at 32, Apple at 30, Meta at 25, and Google or Alphabet at 23. Historically, the average PE ratio for stocks has been around 16, but today, retail investors are piling into these tech giants week after week, ignoring traditional valuation metrics. This blind enthusiasm is propping up prices, but it's also creating a bubble that could burst at any moment. The question is, how long can this last, and what happens when retail investors stop buying? Even Warren Buffett, the legendary investor and longtime advocate of buying and holding the S&P 500, is sounding the alarm. In 2024 alone, Buffett's holding company Berkshire Hathaway sold off $127 billion worth of stock, including a massive stake in Apple. In fact, Berkshire sold 100 million shares of Apple in the third quarter of 2024 alone, and a total of 615 million shares for the year. As a stark warning from one of the world's most successful investors, the day of easy returns in large cap stocks may be over. Buffett's strategy has always been to buy undervalued companies with strong fundamentals, but in today's market, even he's struggling to find opportunities. That's why he's sitting on a record $189 billion in cash, waiting for the right moment to strike. So what does this mean for your portfolio? Here's the reality. The market is overvalued and a correction could be on the horizon. But that doesn't mean you should panic. Instead, it's time to be strategic and focus on these 4 key points. Number 1, stay heavy in cash. Cash is king during times of uncertainty. It gives you the flexibility to buy quality assets when prices drop. As Buffett says, be fearful when others are greedy, and be greedy when others are fearful. Right now, it's time to be cautious. Number 2, focus on undervalued stocks. According to Warren Buffett, stocks with a PE ratio of 10 or less are worth watching. While these are rare in today's market, they do exist if you know where to look. In a future video, I'll show you exactly how I find these hidden gems. Number 3, consider commodities. Precious metals like gold, silver, and even copper, platinum, and palladium can act as a hedge against market volatility and inflation. During the 2008 financial crisis, gold prices surged as investors fled risky assets. The same could happen again if the tech/AI bubble bursts. Number 4, avoid fear of missing out. Don't blindly follow the crowd into overvalued stocks. Instead, focus on long-term value and fundamentals. Remember, the goal isn't to chase quick gains, it's to build sustainable wealth. While the Magnificent Seven may be overvalued, there are still plenty of opportunities in the market if you know where to look. In a future video, I'll dive deep into how to find these undervalued stocks with the potential for 100+% returns. These hidden gems are out there, but they require patience, research, and a disciplined approach. For example, during the dot-com crash of 2000, companies like Amazon and Apple were trading at bargain prices. Investors who bought during the crash and held on for the long term saw life-changing returns. The same opportunity could arise again if the tech bubble bursts. In short, Nvidia's crash is a wake-up call for investors. The market is overvalued and the stage is set for a potential correction. But with the right strategy, you can protect your wealth and even profit from the chaos.